Welcome back as we wrap up the final video of the main body of the course. And in this video, we're going to discuss reporting. So once you've done your bookkeeping, apart from just getting your business ready to do taxes, one of the main things you're going to get out of your books is insights. So what type of report should you be running to get good insights out of your business, to track your performance and to see the overall health of your business? And so that's what we're going to focus on in this video. And there's really two main reports that we're going to be using on a month-to-month basis. And that is going to be the income statement and the balance sheet. And to access those reports, we're going to go to the top to reports. And then here you'll see the balance sheet is one and the income statement is the other. So I'm going to open these up in separate tabs. We're going to take a look at each of them. So here's the income statement. This is kind of the bread and butter statement. It's the main statement that most businesses use to track their performance. So this income statement is also commonly referred to as a profit and loss statement in other accounting systems. So this is where we're going to see the money coming in and the expenses going out and the overall profitability of the company. So I'm just going to break down the major sections. I'm not going to go too much into accounting theory, as I've already told you in the introduction of this course. I'll have a video on where you can go and what are some resources to look up if you need more background on just accounting theory and how to understand the difference between gross profit and net income, all that stuff. So what I'll say here is that the income statement has three main sections. So there's the revenue section, which has the total sales and refunds. Then there's the direct cost or cost of goods sold section, which will have all the different types of direct costs. So the costs that factor into the production of your product. And the revenue minus the cost of goods sold leaves you the gross profit. So this is the profit that your business retains from each item that it sells. So this gross profit figure is a very, very important figure. If you have a higher gross profit, that means you have more money to contribute towards administrative costs like advertising and wages, etc. So this gross profit is really, really huge, especially if your strategy as a business is to create a unique and differentiated product and not so much be the low-cost provider. The next section we have are the operating expenses. So these are all of the administrative costs that support the production of your business. So these things support the revenue that's generated as well as the production. So this is stuff like advertising or consulting, wages, salaries, printing, all of that kind of stuff. So this is kind of the final section. And so what you'll see as you come down here is you'll have total revenue minus cost of sales equals the gross profit. And then all your operating expenses will come as a total. And then you'll be left with the net income before tax. So if you want to plug in tax, you have that. And then you have a final net income figure. So this is what a standard income statement looks like. And one thing I'll say here is that the income statement is for a period of time. So this is over a period of time, what was the revenue and expenses that were created by the business. And so within Xero, the default report is to show you the income statement for the current month plus the previous 3 months, and then they'll give you a year-to-date figure all the way to the right. With reporting, you have the option to change the periods. Here's a few default views at the top, like year to date. But let's say you want to change that up. What you'll do is you come to compare periods and you'll pick a date. So maybe we want to pick for all of last year. What we'll do is we'll go to December 2014. That's where we want the report to end. And then let's say we want to compare each month over the 12-month period of 2014. What we'll do is we'll pick period 1 month as opposed to 2, 3, 6, or 12 months. And then we'll compare that with the previous 11 months. So we're going to do a period of 1 month that ends on December 2014. And then we're going to compare it with the previous 11 periods. So if this is 1 month, 11 periods, this period is going to correspond to whatever period. So if I pick 12 months and then I pick previous 11 periods, it's actually going to compare 12 years of data. So anyways, a typical month by month over a year would be December for 1 month and previous 11 periods. We'll click update. When we do, it's going to show us a whole host of months. And if we click this wide view, it's going to show us all the periods across the whole. And so here you see December all the way down to January and a year to date. And so you have the options to save this as a draft. You can also edit some of these layout options, which I'm going to discuss in one of the bonus videos. Very, very handy function. The final few things you can do here is you can publish this and create kind of a set in stone record of your income statement. So maybe at year end you might publish these, and so when you go to reports, all reports, you'll see these in your posted report section. Also, you have the option to print or to export, and so this is pretty handy if you want to do some more interesting data analysis, maybe in an Excel spreadsheet. Well, then you'll export via Excel here, and from there you can create formulas and run percentages, etc. So this, in a nutshell, is the income statement. Very, very handy. Some other options you have, you can just pick a date range. If you come to this compare period section, you can also elect to show the total. So if I elect to show the total, it'll show me for all the periods that I run, it'll give me a total. I can also elect to show the year-to-date figures. So in this case, the year-to-date was the same as the total. But you also have a few other options. What you can do is if you set up tracking categories, you can filter by these tracking categories. So let's say we set up divisions. We can sort by all of the regions, which we set up a tracking category to track regions. And when you do that, it'll show you your reporting by region, which is very, very handy. So anyhow, that is the income statement. The other statement is the balance sheet. And what I tell people on the balance sheet is that this report is kind of like a statement of net worth. It shows you kind of what is the value of your business. So whereas traditional net worth is assets minus liabilities, your net worth. Well, in this statement, we have assets, and this asset section will go from most liquid to least liquid. And what I mean by that is liquidity just means how quickly can we get converted to cash. So cash is obviously the most liquid because it's already in cash form. So we have cash, and then we have current assets, which are assets we plan to turn into cash within the next 12 months. And then we have property, plant, and equipment, which are the most difficult to turn into cash because we'd have to sell them, dispose them. So anyways, that's the typical format for the asset section. And so we have cash, current assets, property, plant, and equipment. These equal total assets. And then you have liabilities and equity. So liabilities works the same way, most liquid to least liquid. And so liabilities is obviously money that you owe to some other party. And then you'll have total liabilities. And then you'll have an equity section, which equity, a lot like a house, is simply stored up value. So the difference between your assets and your liabilities will equal your equity. So if we have assets of $12,000 and liabilities of $17,000, that means we're a bit under the water, right? We owe more than we actually own, in which case we'll have a negative total equity. So you see 17,000 minus 4,000 will equal about that, almost 13,000. So you notice the total assets is 12,700 and the total liabilities and equities 12,700. So there's a lot more theory you can go into with the balance sheet, but that's a general layout of the land, and you have the same options as you did with the income statement and the same type of compare period section. So this balance sheet is kind of a statement of net worth, of financial position, and it's at a moment in time, which Balance sheets are run as of the end of a month. So whereas an income statement is your performance over a period of time, the balance sheet is your net worth as of a certain month in time. So you ended the month of October with these assets and liabilities and equity. So anyhow, that is in a nutshell is reporting, and those are the two main reports you're going to want to look at on an ongoing basis.